if this is your first time, we basically do these investment club meetings during the last Saturdays of every month. And what we try to do with these meetings is basically to share actionable insights on whatever is trending or whatever is relevant in finance at the moment. So that brings us to today, where we're going to be talking about BRICS. We're going to be talking about the future of the US dollar. And we're also going to be talking about geopolitics, right? And the reason why this one came up is because, it's very hard to miss. You would have heard somebody just randomly saying, oh, the dollar is crashing, oh, dollar, the crash, oh, yuan is the next thing and all of that. And, it now brings the question, because for a lot of us here, I'm sure we are all mostly wise users. I'm sure there's a few of us as well who have been considering using the product. But then you beg the question of, what does my long-term investments look like in the US dollar if I am hearing that the dollar is crashing, right? So all of these speculations have brought us to this topic. We did put out an email about it. We did put out an article about it, but we said, it was also necessary to have one last conversation. And we are joined today with AK, who is going to give us some insights on this topic, right? So the structure of this really is we're going to run through a couple of points. If you're on our Telegram group, you already know the points that we're going to run through. And we'll do this as quick as possible. And then after all of this, you guys can then throw in your questions, make it interactive, and then we call it a day, 1 hour in. All good?
Yeah.
All right, so AK, let's go straight into it. Let's go straight into it. The first question that we're going to ask: let us know what the dynamics between the dollar and the yuan is right now, and if a switch of because right now, the dollar is the most popular reserve currency, right? If that does switch, say in the midterm or in the long term, how is this going to affect our investments rise?
Sure. Thanks for, opening in with straight into the core of the conversation. So the truth is, what we try and do at Rise is, and this is something we believe very strongly. The goal is not necessarily to only expose our users to dollar investments. What we are trying to do, for instance, Chubi, you are aware that we're having internal conversations about how to add exposure to India into our investment options, because we are seeing opportunity there. So some of these conversations, they take time to materialize because they have a process that we always have to look at. But our job is to look at the facts objectively and say, this is the best place for your, I'm trying off my video to improve so that the bandwidth is better utilized. But we look at the overall landscape objectively and say, this is the best place for your money to go, or these are the best options in terms of investments for people to have access to. So if at the time where we feel it's material enough, or that they are investments, so we're not necessarily speculating on currency values, right? We're not saying, invest in the dollar because the dollar is going to keep rising. No, we're saying, here are the assets that are going to do well in the future, and a lot of them happen to be denominated in dollars. So just to try and provide some color about what would happen to our investments. But the dynamic between the dollar and yuan is interesting because it constantly shifts as the geopolitical balance between China and America shifts, right? And again, some of these things many of you are already aware of. So the first is that China has become the largest trading partner for very many countries, especially in Africa, parts of Asia, and increasingly Latin America, right? So they are expanding their trade footprints. They've been the dominant manufacturer globally for a while, right? And so even though there's other countries have started to muscle into their making for the world territory as cost of labor in China has increased, China is still moving up that ladder in terms of technical ability and increasing the complexity of their manufacturing. So now, for instance, they're even shipping, they started to be a net exporter for cars, which was, until very recently, they were a net importer because they were not making all the components or the most in-demand cars in China until very, very recently. So as China's role in the global trade environment has expanded, they've been pushing pretty much since 2011 for more countries to essentially deal directly in yuan, rather than having to settle or transact trade settlements in the dollars, which is the default for most people. So that dynamic has been there, where China is like, more people should use the yuan. And as they've become bigger and they've become stronger, and they've started to also have a more adversarial relationship with the US, they've been increasing that option, or telling more people, you know what, settle our trades in yuan, or increase the number of our trades that are settled in yuan. But with that being said, you know, and we'll have a lot more opportunity to, I guess, lean into this. With that being said, though, about the percentage of China's trade that is settled in yuan versus settled in dollars is still, right now, it's about 23%. It's actually still below the level it was in 2015. So as at 2015, and this is something a lot of people might not be aware of, as at 2015, about 29, almost 30% of China's trades were settled in yuan. The balance was in dollars. That actually dropped to about 18% by 2017, 2018. And now it's kind of like climbing back up. So this year, so far, it's about 23%. So we're seeing this uptick now, but we've been here before. We've not even exceeded the 2015 levels in terms of how much of China's trade is settled in yuan. So that's one side of the equation. The other side of the equation is the reserve currency side. So I always look at this entire conversation in two ways. One is the trade, the medium of exchange. How are we paying for what we are buying from you? And how are you, what are you using to pay us for what you want to purchase? So China is saying many people should use yuan for this. And there was even a time they negotiated a yuan swap deal even with Nigeria, so that more people can just order things from China in yuan and not have to go through the dollars, which was great for both sides. So the medium of exchange is one side of the equation. The other side of the equation, which is the more interesting part, is the reserve currency side, which is, so I'm Chinese government. I have all these imports or exports that I'm getting paid. If I'm getting paid in yuan, which is roughly again 20-30%, all of that goes back to my central bank, and the other country has to maintain reserves in yuan so that next time they want to buy, they will still come in, they'll have the currency to buy with, right? And so that's other countries' central bank has to hold some yuan in order to do business with me. But the other portion of my trade that is coming in dollars, when they pay me in dollars, I also have to keep that money somewhere. And that part is where China has not quite dislodged the US. And it's a much bigger portion of the US dollar demand, the currency, reserve currency part. Because the trick is that there's two aspects of that side of the problem, right? And I'm trying to figure out a way to keep it very simple, because by the nature of the conversation we're having, it's a bit complex. So if I'm getting too complex and I need to explain it better, please let me know. But when China sells to the world and they get paid in a lot of money, majority of the time they still get paid in dollars. If they hold their money or convert it to yuan in their own currency, the value of yuan will increase to the point where people cannot afford to buy Chinese goods anymore, which will lower their exports. So if you're paying me in dollars and I keep converting those dollars to yuan, that means I have to be buying dollars all the time. The average Nigerian should be able to relate to this, because we are one of the few countries in the world where we are very conscious of how our central bank has to buy or sell dollars and naira, because it's such an everyday conversation for us. So that's where we have some advantage, because there are some countries where what I'm saying will sound, they don't understand it. They just know you buy things and you pay for them. They don't get it from that level. So, but if everyone is paying China in dollars and they want to keep their reserves in yuan, then they have to convert all that dollars into yuan, and their yuan value would increase, and they will basically price themselves out of the market. So they don't do that. What they do is they lock the dollars outside of their economy by buying US treasuries. And that part has not really stopped. That part has not really been broken, because despite all of the news going on in the media about more and more people settling in yuan and the rest, China has not figured out, okay, where will I keep all this excess surplus or trade surplus that I'm generating from my exports? I can't keep it in my local currency. I'll become too expensive. I can't park it in the so-called BRICS nations, because none of them have the ability to absorb that much dollars. And none of them have the kind of stability and trust and liquid markets that America has. So despite all these conversations about dollar switching and all, China is still the biggest buyer of US dollar-backed assets, which is mainly the US Treasury, even today. So based on just that and that high level, to answer that question is, on the trade side, China is trying to get more people to deal directly in yuan. But on the reserve side, China is forced to push all that surplus back to buying additional dollar assets. So it's a strong and very tight complementary relationship between those two currencies, and it's not changing anytime soon. Another example for something like this is the euro and dollars have the exact same relationship. And the euro, when it was launched in 1990, a lot of people were saying, oh, it's going to make the dollars obsolete. 20 or 30 years on, that hasn't really happened, because most of the biggest, European Central Bank and all the rest, most of their biggest trade partners all have to still push their money into the dollars. So I see a situation where Chinese yuan and dollars also develop that kind of symbiotic relationship, despite all the media hype around, or one is trying to replace the other. So I don't know if that's provided clarity, but that's what I would say for now.
Thank you. Thank you so much for that, AK. Great explanation. So just like you said, I think this is it's a complex topic. I don't think it's something that we can exhaust in 1 hour. So what I will do is I will post the investment club link on our chat there. So guys, you can join our Telegram and we can continue having these conversations like throughout the week, right? So AK brings me to my next question. Like you said, we did speak internally about emerging markets and regions that are coming up economically. So our next question is, what are the best places to invest in right now in the world?
Yeah, so the great question. So the thing is, anytime you're investing, naturally you're looking for, if you're doing investing properly, you're looking at a long-term horizon. You're not looking at next year. You're looking at minimum 3 to 5 years, right? I mean, at the very minimum. Ideally, you should be thinking in decades, 10 years, 20 years. But for the most people, realistically, you're looking at the next 3 to 5 years. And so if I take that view and ask myself, where should the average person be thinking about investing for the next 3 to 5 years? So a number of options are there. One is, so within the US, well, let me paint a picture. If you step back and see, okay, what is going on in the overall economy globally? One is inflation is still a problem. It's a receding problem. The headlines about inflation have reduced because increasingly many people are starting to tackle it. But inflation is still like the biggest, I guess, factor on the global economic stage. The next stage, or the next thing to consider, is energy flows or energy resources. So you see Russia, Saudi Arabia, talking about, their OPEC plus arrangements around oil production, oil prices, Exxon and the rest of them. The Arctic opening up, and Russia and US and a bunch of people talking about the oil reserves out there and what that would do to the global supply. You see a lot of conversations about clean energy and climate change and all the technological developments around that area with solar, with some chemical nuclear stuff. A lot of that is becoming a factor for what is happening globally in the global economy. The third thing to consider is the supply chain and geopolitical disruption. So people are basically saying globalization has kind of like run to a point, and that increasingly we want to shift to a multipolar world. So where it's not just about US and its global supply chain control, it's more about different people or different countries exercising control over different regions, and countries are shifting their supply chains to better reflect their own security considerations. So in the backdrop of all of these things, you then ask yourself, what is the potential impact on the investment landscape? So the first is that countries like India are becoming a more important player on the global stage. We've seen, even since we've started looking, because again, we started looking at India pretty much since last year. However, getting very direct exposure to the Indian market is pretty challenging. There are workarounds, and we're currently having conversations about those workarounds. But it's one of the places where, so China, Apple just opened its flagship store in Mumbai. We wrote about that. I believe it's been published on our blog, or it will be soon. But we had an internal article that we did on this. They are shifting more of their manufacturing towards India. India just surpassed China as the most populous country in the world, and their population is also relatively younger. They are also globally connected with their diaspora, and so a lot of things have lined up positively for India, and it is a very strong opportunity or growth market in the emerging market space right now, while a lot of people are shifting away from China. So that's one area where we think there's great opportunity. And like we already hinted at, we're going to do some work to make sure that our users get a reliable and consistent way to invest in that market. Secondly, truth be told, US is still probably the #1 investment destination and will continue to be so. So other than the advantages of its financial system, when you go beyond, because generally when people talk about US as an investment destination, people just first talk about its markets, right? Its financial markets, stocks, real estate, and the rest, again, which is even where we're starting, where we are already sitting as well. But beyond that, as you think about with the changes happening in the world, US has several things going for it. One, a huge population, huge landmass, energy independence. It generates supplies most of the oil it needs for its internal economy. To drive an internal economy can be produced at home, and that has even driven some of the I guess the reduced pressure for the US to maybe play as active role in the Middle East or some other places, because they realize that, yes, we're doing all these things and it's great, but some of the reasons that we're doing it, which is to maintain our energy supplies, we don't really need to anymore, because we have like really huge shale oil supplies across the US, and we still have a long ways to go before those become tapped out. In fact, they're even exporting and affecting OPEC oil price setting with their own production. So US is energy independent, and increasingly in this future that we're entering, US has that energy dependence. Even China is a net energy importer. They import oil, they import a lot of things, which is why they've also become one of the leaders in solar technology, because for them, it's how do we rely less on the global energy markets. So US is energy independent. US has almost pretty much, in terms of food production, is also independence, right? So it's a net exporter of food, it's a net exporter of energy, which means electricity cost in the US is among the lowest. And with advances in AI, manufacturing, the cost of labor is becoming an increasingly less of a bottleneck to US manufacturing. So we're seeing a lot of internal, like re-inshoring of the US manufacturing supply chain. Factories are being built in the US at an active pace. Even foreign countries are increasing. Like I can count at least 5 different locations, and we track this for our real estate investments research, but there's at least 5 different locations in the Midwest, some corner of the Southeast, some corners of the far Southwest, Idaho, where people are, well, Idaho is still Midwest, but they are building factories, car companies, chemical companies, manufacturing companies, and it's driving a lot of increase in the US manufacturing PMI increased above 50 this past month. So US is still probably one of the best places. And if things continue to go crazy on the global stage, you realize that many more countries will start to kind of be inward facing. And so if you rely on external places for capital or for food or for energy, you'll probably not be in as good a shape as people who do not have such requirements. So it's still like my number one place in terms of where to invest. And then you can discuss, but in terms of what assets to invest, other than the traditional ones, smaller businesses and private equity investments are becoming increasingly in demand. In the US, small cap stocks have started to grow. The last 10 years has been large cap stocks, the Facebooks, the Googles, but now people are paying attention to smaller cap stocks who have some more economic resilience at home, and they don't have as much exposure to international issues. So the third place, again, for me is, if you look at the continent of Africa, Nigeria and a few other countries more, but kind of 50-50 between Nigeria and a few other countries, there are several things that point towards investment opportunities, again, around the smaller businesses space, focused on niche economies. In Nigeria, a lot of them are focused on export kind of businesses, things that are going to be making FX, or things that are in the agricultural processing space, because those 2 places are going to continue to see a lot of increasing demand over the next 10 years. So again, this is not an exhaustive list. There are a bunch of other, I guess, niche or nuanced ways to think about investments. But for Rise, what we've done, as always, is figure out where the best investment opportunities sit, and then build out a steady and stable way to access those investments or those opportunities, and then make them available to our customers. So I know that, again, knowing them and talking about them always precedes actually building out a product around them and then making it available to users. But we have to do those things properly, and it takes a little bit of time. But yeah, so we're going to make some of those additions into the product. But even if you're not only investing in Rise, you can also look around in some of these places that I've mentioned and figure out how you on a personal level might want to invest. But ultimately, the goal for Rise is always to make sure that the investments that we have available to you, we know that they are going to be the things that will do well over the near future.
Thank you, AK. Okay, so I just looked at the time. I think we're going to use 10 more minutes for our own segment, and then use the rest just to answer questions from the audience, right? So please, I'll stop you at exactly 2:40. Okay. So we'll try to squeeze some questions in. And guys, please send your questions in. So I've seen a few questions from members of the audience. You guys sending your questions in the Q&A section, and then we'll get to your questions after this. So AK, my next question, we've touched on this in previous meetings. So briefly, please, what would you say is the short-term and long-term impact of the conflict, of the Russia-Ukraine conflict on our investments?
I'll just be very quick with that. I think it's the biggest issue that it will drive is macroeconomic instability, especially for large swaths of Africa, right? So within our own real economies, how it will have a lot of effect in the short and long term, right? So whether it's on food prices, on imports, and a few other things, the ability for goods to flow freely, so shipping costs will increase and all. On our actual investment options, not very much. So if you're already investing in rice, or if you plan to continue investing in rice, the Ukraine conflict might not affect unless, again, only to the extent that it affects the global economy. But where I'll be cautious of is that it's one of the contributory factors to the potential recession everyone has been talking about. So all of the effects of this war is more on how it affects costs in different economies, how it affects demand, and how it ultimately contributes to recession. But on our actual investments on some of our stocks, real estate investments, a lot of the fixed income assets that we have currently, the effects is very minimal.
Thank you, Ike. Okay, guys, keep your questions coming in. I'm seeing these questions coming in. So Ike, you have about 9 minutes, right? So I'm going to throw a 3-in-1. Is a recession coming? How do I prepare for a recession if it is coming? And how is Rise protecting our assets in case of a recession? That's a 3-in-1. Let's go.
All right. So is a recession coming? Very likely. That's the only way to answer that question, unless you can see into the future. But it's very likely. A lot of things point towards a potential or a recession coming in. When? Who knows? But there are several indicators. Not going to run through all of them, but there's credit crunch that is happening. Banks are slowing down on lending. Earnings, even though the last earnings reports from a lot of companies still showed some strength, but many companies are guiding lower revenues, lower profits. There's, inflation has been tamed, but not quite. So there's a 50-50 chance about whether the US Fed would increase rates at least one more time or not. So there are other things that also still show that maybe we can avoid a recession. So job markets are still strong, housing markets is still strong, inflation is showing some reduction. In China, despite all the inflation and all the shipping and logistic problems, China's overall exports are still higher. Demand is still there. Oil price is still strong. So it's a very 50-50 play right now. But the indicators point towards there is a strong potential that a recession would come. But whether it comes or not, it's always a good idea to be prepared. So the most important question is, okay, what is Rise doing to protect assets for our investors during recession, if a recession does materialize? Since maybe last year, we've been rotating into like much stronger or much more defensive stocks that we feel can ride out the pretty rough time. There's been an increase in consumer defensive stocks, very large like media and tech companies, and a handful of companies that have stable demand profiles. So there's some healthcare. There's a handful of companies that we're also still looking at because we feel like, okay, as things get worse, these guys might do okay. We've also, generally speaking, again, for our real estate, the worst impact might be that rental income might drop if there's a lot of vacancies. But the property portfolio has zero debt on it, because during a recession, it's the debt payments that you're not able to service or refinance that typically kills you, not the actual exposure to real estate, because the asset class on its own is very, very stable. So we've tried to, we look at all the risks that we're exposed to, and we feel very confident that, yes, we're going to do all right, even if a recession happens. Then on the personal side, some of the things that we advise for people to do is, if you have, say you were the 2 to 3 months emergency fund person, maybe extend it to 4 or 5, maybe even 6. Look at ways to either protect your income or earn additional income, especially now that the internet allows people to make money from, global job opportunities. Because if just because there's a recession doesn't mean that your skills are not demanded somewhere. So if it's not at home, then look outside. But there's several other strategies that we believe people can do to prepare themselves. But on the investment side, we also tell people, so this is one of the key things we advise. Understand that. So between 2000 and today, there's been at least, so there was the dot-com, there was the 2003 wasn't quite a recession, it was more like a pullback, but there was 2007, which was the major one. Then there was the 2021 due to COVID, and everyone who has stuck or kept investing through those downturns, especially continue to put money in when the market was down. If you have the ability to have almost always come out on top. A lot of people who were trying to run away from investing because there was a recession, or maybe because your portfolio was down and you want to pull out and pull away, either locked in losses or missed out on some of the rebounds, because when those rebounds start, they happen quickly. The market just flips over. You don't even realize the recovery has kicked off until maybe 6 months down the line, when you realize that, oh yeah, the economy is bouncing back and the stocks is bouncing back, but you've missed out on a portion of your potential bounce back returns because you left the market. So that's one of the reasons why we always advise our people that look at your investment as a long-term journey. And some days things will be up and some days things are going to be down. Don't
Okay, thank you. AK, are you done?
I'm done, Chubi.
Oh, sorry, I thought I lost you for a second. All right, thank you so much for that. There are some hidden gems in there. I hope we're all taking notes. So let's jump into the questions from the audience. Excuse me, please. Yes, I'm sorry about that. So let's jump into some questions from the audience. All right, so Anonymous says, thank you so much. I have a couple of questions. Please, could you share your views on how the US dollar and BRICS countries can affect different types of investments? Okay, do you want to take that?
That's a bit of the, I won't call it a vague question. I think it needs a little bit more precision. So how they can affect different types of investments. So it depends on how the situation resolves, right? So it's a hard question to answer because maybe it's me not understanding it fully. But so let's put it this way: if more of the world starts to switch from dollars to yuan, first of all, on a personal note, I don't think that's really going to happen. It'll take something really catastrophic, something as bad as like a full-out war to redraw the financial system like that. Because so there's about $12 trillion of Eurobond investments globally, right, issued by several countries, and they're all like controlled by it's the euro dollar market is external sovereign debts, but they're all denominated in dollars. How do you want to unwind all of those assets? All of those loans or portfolios? How are you going to restructure them at scale? Who knows? But that's one area it might impact. The US Treasury markets, if things get to a point where everybody wanted to sell their US Treasuries, then the US Treasuries will probably, I guess, drop, and which means their yields will go up. And then that would impact global cost of capital for pretty much everyone. But again, if you sell your US Treasuries, where do you rotate that money into? Is it the euro, which is an unstable monetary union, Germany is the only one there that has the full credit worthiness, but Germany is in austerity mode, and part of their surplus is used to backstop the other countries in the Eurozone that are not doing as well. So you don't have the stability and the monetary policy clarity that would allow you to park your reserves completely in the European Central Bank's reserves. Is it Japan, which is Asian? Is it China, which has a lot of a lot of it's made about the BRICS, but China has capital controls, is export dependent, so it's not going to absorb everyone's currency or reserves because that would make it uncompetitive. So where really would people move the more than 20-something trillion dollars in US treasuries? Nowhere except the dollar. So it's hard to speculate about what will happen to different investments if the dollar yuan or dollar BRIC situation, because nobody really knows what it's going to do, right? But my bet is we've seen these stories before. We've heard in the Japan era, people are like, oh, we don't want dollars anymore. We heard in the Russia era. Now we're hearing in the China era. But when you look at what central banks actually do, including Chinese central bank themselves, everyone is still buying dollar treasuries hand over fist. So for now, we don't think a lot is going to change.
Thank you. So the next question is, are there any potential implications of digital currencies on the US dollar and BRICS currencies?
That is a more, yes. It's a more interesting conversation. I think it deserves a full discussion of its own, because a lot of the long-term effects or long-term implications are domestic in nature, right? So trade settlements, instant, like now, thanks to the Fed coin, the US is starting to develop what we in Nigeria have always had thanks to NIBS, which is instant transfer settlement. So Zelle was like a step in that direction, but like we're increasingly getting to a point where you send transfer to someone, they get it immediately. Zelle will credit you immediately, but it still has settlements for T+2 days. Digital currencies allow, digital central bank issued currencies will allow those to be settled instantly. For the non-central bank issued digital currencies like USDC and the rest of them, Bitcoin and co, what it mostly enables is more transactional financial flows globally, which actually works out to the US's benefit. I mean, think about all the people using USDC globally. They are essentially using a dollar derivative, right? Even though it's not issued by the US government, they're essentially using like a dollar contract. And so it increases the catchment area of the US dollar because it allows, and it makes it easier for people to move their funds into where they consider safe havens. But all of those things generally work out to dollars advantage. The internal implications, I think those, to do them justice, we have to have a full conversation on that. It's not a 2-3 minutes conversation at all.
That's correct. So, I mean, we have a potential topic right there. So Ikechukwu is asking, he's basically asking about alternative asset classes like wine, art, and precious rocks, and also asking if RiseVerse is looking to increase its product range to include those alternative asset classes. So first of all, how do you think about these alternative asset classes as far as like investing goes? And also, are we looking to actually go into that line of investing sometime in the future?
So the answer to that is, are we looking to this? So start from that, are we looking to go into this line of alternative assets? Absolutely. I'm dropping the link to Asset Base, which is one of the platforms that we're launching that will expand into those alternative asset classes. So if you guys, I'm dropping assetbase.capital. So right now it's just a wait list, so that you get updates as far as like when those things as we start to develop and push things out, launch the beta and have people test different aspects of it. So if you go to assetbase.capital, please join the wait list and you get some information on what we're going to do around that. But generally speaking, these asset classes, they're interesting, they provide stability. So you look at three things when you're looking at an investment. You look at stability or the risk profile, you look at liquidity, you look at the yield. So a lot of them have the safety and stability, especially if you hold the physical assets in a trusted custodian. But the liquidity is a challenge, right? So when you need your money and you don't have access to it, you're not going to do much with a bottle of wine. You need the physical money, right? So that liquidity part, there are multiple ways of trying to tackle it. So people that this type of asset classes make the most sense for, arts, wine, and the rest, are people who have the ability to just lock those capital down for a really long time, and they are happy to harvest the higher returns because they don't need those money in the short term. So we are looking at those considerations, even for the platform that we're building. Part of the things we're looking at is how do you create more liquidity? And so as we solve those problems, again, we'll make them available to RISE users. So it might not be on the RISE platform, it'll probably be on asset base. However, our goal again is not to provide the assets that is a challenge, is to make sure that people can withdraw, people can understand how it works, and set expectations correctly. Because as you all know, it's very easy for people to say, we invested in this, and so we want to make sure that we get that experience right, test it with our users before we roll it out to everyone. You are there?
Yes, sir, I'm here. So I'm just looking through the questions. Thank you for that. All right. So please, do you just want to quickly speak about RISE's US SEC license, because someone here is asking a question saying why, okay, this is when a US asset management company is not regulated by the SEC, is it a red flag? So do you just want to speak on that? I think Ikechukwu must have missed our announcement.
Yes. So RISE is registered with the US SEC. RISE Vest Investments LLC, that's the entity on the US SEC's advisor sec domain. So you can actually go on and search our entity. But yes, we are registered and regulated by the US SEC, which is the strongest regulator for what we do globally. There are situations where it is possible for a US asset management company to not necessarily be regulated by the SEC. If you're primarily serving either very qualified, what we call them qualified investors, accredited investors, you can get away with maybe not coming under SEC's jurisdiction directly if you're primarily serving foreign clients, non-US clients. But for us, the reason that we filed to get regulated by the US SEC, one is because we wanted to make sure that people knew that RISE is a platform that they can trust and that we operate at the best standards of I don't know what the right word is, the level of operations is very standard. And then secondly, we also have plans to expand our reach across a lot of countries. And so the US as your primary regulator provides a level of comfort and trust that helps make conversations with other places very comfortable, as well as provide that signal to our users that yes, the way we do things here is globally standard. We're not just I guess that's but yeah, so we have that. But yeah, there might be situations where a US company, if you're targeting a small narrow band of clients, you might not be registered with the SEC.
Okay, so, thank you, Rick. Okay.
The questions about details on our products, please just, I guess we can just type that, but they should reach out to hello@RiseVest so that we kind of stay focused on the core conversation. But if you need information about our portfolio, send a message to hello@risevest.com. I'm going to type that out here as well. So, but I'm saying to everybody else so that if your questions revolve around, getting more details on our assets and every other thing, the nitty-gritty of how we manage them, please send that email. so that someone from our team will walk you through them.
Yes, I was just going to say the same thing. So I see a couple of questions about the real estate option here. You're basically asking a product question. Please send an email to hello@risevest.com and somebody will reach out to you with the information that you need. Also, there's also a question here about someone said, I recently just relocated to the UK. Can I still continue my investments here? I'm assuming you're talking about your Rise investments. The answer is yes, you can. We have users who also do not live here in Nigeria. Just reach out to hello@risevest.com to get like the best options to fund your accounts from your location. But yes, you can still carry on investing. Okay, so Ike, we definitely have to end this at 3 p.m. So we'll take one more question.
Before we take that, I wanted to
Okay.
address this question about, so the one about, so what is your take on the issue that China needs to move away from communism to further gain trust of other countries before we can begin to see further adoption of the yuan? And then what are the lessons from Rise from Ghana Eurobond default? I think those two questions are really relevant. So I wanted to address them. So I'll try and keep it very, very quick. So the first thing I'll say is that, yes, for people to hold, for more banks or more central banks to hold their reserves in yuan. So there's a way people have talked about this in the media, and a lot of it is very politically driven. So Russia and China are really trying to push back on some US sanctions. And so they are making a lot of hype around the fact that, oh, they're going to switch from the dollars and all. But the truth of the matter is, when central banks are making decisions, they are making very commercial, very economically driven decisions. They might say a lot of things that are politically driven, but what they do is what really counts. So if I want to put my reserves in China, China has capital controls. So my reserves being in China, in Chinese government bonds, if I need to pay for something tomorrow, I need to sell those government bonds and receive the money in cash so that I can settle my trade balances, So in a scenario like that, China's capital controls becomes a problem, because if I'm Brazil, I have a lot of trades with a lot of countries, and I want to pay them. And China says, sorry, you can't pull this money because we don't like the people you're trading with. That's a problem. Or a lot of the people, China is like, well, you can't move this money around this so and so time. Because they want to make sure it fits with what they want you to do, because China doesn't have the concept of private property rights. Everything you do has to be subordinated to what the state wants. And so if all your reserves are locked up in the yuan and you don't have the ability to move it at will, to sell it to who you want, receive your payments on time, that's going to be a huge problem. So for China, it might not be moving away from communism per se, but definitely liberalizing control of your currency, making it easy to trade and move around, having a very strong capital markets where I can sell. So let me give you guys another example. There was a period, Japan is a relatively capitalist country. Well, not relatively, it is full on capitalist. But a lot of people who are holding Japan's government's debt realize that the market is dominated by one counterparty, the Japanese central bank. 60% of the trades there are driven by them. And there are periods when people want to sell, but there's nobody to buy because the Bank of Japan is not buying. And nobody else has the interest to buy them from you. So you sit for days at a time with no trade. It literally still happens. I'm telling you, as recently as this year. So if you were someone that was holding a lot of Japanese debt and you needed liquidity, and for 3-4 days, you couldn't get any counterparty to purchase from you, you're in a very rough place. Now, imagine the Chinese version where there's no other markets, no other place that Chinese yuan can be, Chinese government securities can be bought or sold except from the Bank of China. It's one counterparty. If they decide to buy from you, you get something. If they decide not to, you can't do anything about it. That doesn't make for a very comfortable experience for any central bank. So despite all of these conversations, a lot of changes needs to happen from the Chinese side for anybody to really park their money in Chinese yuan for the long term. So the other thing is, what is Rise learning from I've taken 2 minutes and now 3 minutes. So what is the lessons from Rise from Ghana Eurobond default? It's not a new lesson. Because a lot of people see us as just primarily tech, and it's like, it's fairly, yes, we're primarily tech driven, but there is a lot of risk management muscle that we operate with, both from my own professional background and a few others on our team who have worked at Stanbic and even some US firms. So we always know that for you to put money in any country's sovereign debt, their macroeconomic profile is very important. For the last 2 years, we've been signaling that we've been moving away from a lot of the emerging markets or African Eurobonds that we were investing in when we started, especially the Nigerian one. As far as 2019, by mid-2020, we've already started to rotate out of most of them. We had the opportunity in 2019 to invest in automobiles, and because of the capital controls, it was 14% a year, but because of the capital controls and the macro profile of the country at the time, we didn't want to dabble into it. So we've generally reduced our exposure to a lot of African Eurobonds, and many of our fixed income is now driven by mostly, again, some US mortgage debts, some corporate bonds, some especially Asian, but it's more emerging markets, consumer credits. So a lot of people doing lending, but we vet them strongly. And so the people that we have a lot more confidence in is some providers that operate in both US and some Southeast Asian countries. But again, these are provided by third parties. And we still have some Eurobond exposures, just not as much, right? So there's Angola, there's Egypt, but not just as much as way before. And even the ones we're holding today, we might not be holding them next year, because a lot of our fixed income at 12 months duration, because we always want to renew. We always want to see what the risks are that we're taking as we go along. So now, for instance, US fixed income markets are beginning to pop, which means that we're going to start to see even more exposure on that side. So it's not a static thing. And we could have seen a lot of these things coming, the Ghana one. So, but ultimately, it's not a new lesson. It's just a constant lesson that you must learn every day. So, Chubi, please, what's the last question that we want to take?
To be honest, I don't even know if we can take one more question, because it's 2 minutes to the hour, and there's some good questions here. This one is a product question: virtual cards and accounts. That's a product question. Can I make withdrawals in euros? Is product question, but no. Can Rise look at the possibility of paying monthly real estate returns into our wallets? It's a product question as well, but we've also gotten this. Yeah, we've gotten this feedback from users, and I can tell you for sure it's something that we've discussed. And AK, if I remember your response, it's basically some dynamics that has to be worked around. But if it's something that works, if it's something that the users want and something that is valuable to the users, it's something that Rise would definitely consider.
Absolutely. So it's 1 minute. It's 1 minute to the end. We want to stop at exactly the hour mark. So let me just make some closing remarks regarding the entire conversation as a whole. I'm going to use the comment that Temitope made here, which is, I think, another important metric is the total number of debt in US dollars. More than 70% of world debt is still in dollars, which means there will still be demand on dollars to service these debts. Absolutely. But to then expand from that, so yes, there's that. A lot of the countries that are talking about, they are switching to gold from dollars, are still buying way more dollar assets than gold. China bought 6 billion in gold last year, 70 billion in US treasuries. India bought 2 billion in gold and 50 billion in US treasuries. UAE Dubai bought 2 billion in gold and about 35 billion US treasuries. A lot of in the global stage, in terms of where do you want to keep your money to make sure that it's safe, it's liquid, it's available when you want to buy it, you have multiple counterparties, so you don't rely on any single person that would make or break your deal. Chinese yuan doesn't even come close, right? It's the dollars and then the euro and then Japanese yen, then maybe the UK pound, and then you see the yuan, right? So yuan, despite all the hype, is about 4 or 5% of global trade. America is still by far the largest settlement currency and remains so despite, again, all these trends. But ultimately, again, even for central banks, there's not a lot of alternatives to the US treasuries. But ultimately, the important thing, the underlying thing is not the currency, the dollars as a currency that Rise is banking on to drive the value of your investment. Is the quality of assets, the assets themselves. If we find out that India is the best place for those assets to be, then that's where they'll be. But even your investments that are outside of Rise, it's not the currency they are in. So Naira has the inflation profile that it has, 17% this year. No matter what yuan and dollars do, what you need to worry about is the relationship between dollar and Naira. So UK pounds has not been a reserve currency for years, since 1940, for decades. But I bet if you look at the quality of investments that you have, if you were invested in, so maybe the UK economy, over the same period, reserve currency or not, you're perfectly good. So it's important to keep these things in perspective, because yes, we're in Nigeria and you're always going to have Naira investments because you're always going to spend money in Naira. But you also want to make sure that you are hedging that exposure that you have by keeping some of your long-term investments in the dollars, which is still, despite all the hype, and in assets that are going to continue to gain over time, whether it's our real estate portfolio, whether it's some of the stocks. Facebook, for instance, dropped 14% return yesterday, and it's continuing to expand its footprint. There's several more companies like that. They are not in the Chinese economy. They are not listed in yuan. They are listed in the US markets, and they are denominated in dollars. So it's not about just which currency you're in. It's about which assets, which investments you're invested in. And if those investments are no longer the best place, trust me, we're going to also have the opportunities or ways for you to bring your funds and your investments into those new opportunities. And that's what's more important than whether or not we're settling trades in this currency or that. So I think that's what I want us to close with. Chubi, over to you to conclude the meeting.
Okay, thank you so much, AK. This has been another insightful one. So guys, we've pretty much come to the end of this. There's still some more questions here. So what's going to happen is I've been sending the investment club link on Telegram here on the chat box. I'm sending it one more time. Please, guys, do well to join the Telegram group. This entire conversation is going to be summarized. I'm going to summarize this weekend, and I'm going to post it on Tuesday when we resume work, right? So, and also for everyone who attended this, and everyone who registered but couldn't attend, you're also going to get a copy of this recording in your email. So Zoom will send you an email. I'll just put in the link there, right? So you also get that on Tuesday. So please join our group and let's continue this conversation. Ask your questions there, and it's something that we can keep talking about, right? But I'm very grateful for the interaction. I think we did have some healthy questions. It just shows how people are thinking about their investment and going into the future. So again, I want to say thank you to AK for this. Thank you to everyone who showed up. Yeah, and that's it. See you guys next time. See you guys on Tuesday, actually. So yeah, thank you. AK, cheers.
All right,
Bye.
guys. Thanks, everyone. Bye.
Yep.